Hello, my name is Rodney Holcomb. I'm an agribusiness economist with Oklahoma State University's Food and Agricultural Products Center. Today I want to talk to you for just a minute about a feasibility template designed to help those who are thinking about constructing and operating their own small multi-species meat processing plant. Now, whether this is a state-inspected plant or a federally inspected plant, there are a lot of issues to be taken into consideration. The cost of building the facility, the cost of equipping the facility, and how the facility will operate to generate a profit for its owners. This template is a free spreadsheet that is available for download from the Food and Ag Products Center's website, fapc.biz. If you go to the website, click on Services and Disciplines, then on Agribusiness Economics, scroll down on the right side under Resources, you'll see the link for the download of the Small Meat Plant Feasibility Template. When you open this file, the first thing you'll notice is the introduction sheet on this workbook. It tells you a little bit about how the template is designed to be used. It explains that most of the cells in the template, because they contain formulas, are password protected to prevent them from being changed or misused in some way to misrepresent the viability of a business operation. It also says that users are asked to put their information in the green shaded cells, which I'll show you in a minute. There's also a user's guide that's an embedded PDF document in this template. That tells you a lot about how the template operates and also gives you some good reference materials to examine. When you're ready to use the template, click on Start Using the Template. It brings you to the sheet that's the basic operating and production assumptions. First and foremost in that, the slaughter capacity of the facility. How many head of livestock can be slaughtered in a given week, and how many weeks per year do you expect to operate? Now under that, you'll find where you can provide information for one or more species that may be processed in this small facility. We have a very base case scenario developed here where we have 3 species being slaughtered: cattle, hogs, and lambs. And each one is given a percentage of annual slaughter capacity. Now, if you try to exceed annual slaughter capacity, a message pops up showing that it can't be done. That goes beyond what the plant's supposed to do. For each of the 3 species, you provide information about the hanging carcass weight per head of livestock slaughtered. With that, you also provide information about the basic slaughter fee per head, the boning, cutting, and packaging charge per pound of hanging carcass weight. Then you also get to add information about any further processing that may take place. Hogs are a good example of this because of bacon, ham, and breakfast sausage that are often prepared from a hog. So in this case, our 210-pound hanging carcass for the hog, we're assuming 86 pounds of that are going to be turned into further processed, smoked, cured, or otherwise further processed products. And for each one of those pounds of product, there's an additional processing cost per pound. Now you also get to enter any information about packaging materials. These costs can vary depending on whether you're using plastic and butcher paper to wrap these products, or if you are actually using vacuum packaging and boxing the final product. For each one of these 3 species, you can provide all of this information. You can also add in a little separate business category. And a lot of small meat processing plants, especially in Oklahoma, where I'm at, deer processing is a seasonal activity. So during deer hunting season, hunters can bring their deer to these small processing plants, and for a fee, they will break that carcass down into packaged meat products. So you can enter information here the same way you do for the other species and include the further processing pounds per head and further processing cost per pound. For a lot of deer operations, that may be jerky or snack sticks or summer sausage, but you get the idea. And also introduce your packaging materials per head. Now for the rest of these species, there is an assumed quantity of processing that takes place per year. Deer, a small plant may decide they're going to do a few head the first year and grow from there, so we actually allow you to build in a year-to-year capacity increase. That shows up on the market projection sheet I'll show you in just a minute. You may also have the opportunity for other sales. In this case, for our base example, we're assuming that our plant will have a small meat sales counter, a retail counter at the front of the plant that will sell about 10,000 pounds annually of product, a variety of product. It's hard to tell what it may be, so you take your best guess at this and try to estimate what you think the revenue per unit will be, average cost per pound that's sold, and the cost it was to buy each of those pounds that were sold. And like the deer processing, we allow for a little capacity increase. So as you get notoriety for your business, it may take off. Expenses for operating such a business, the most basic ones are going to be electricity, gas, water, and sewer. Of course, you also have to consider for phone and internet expense, maybe even considerably more expense in the phone and internet area if you're a federally inspected facility where your USDA inspector has to have his or her own separate showers, locker room, office, separate phone line, separate internet line. You also have to think about inedible expense. Get with a local rendering company and find out what they may charge to service a small plant to pick up offal, bones, and other waste meat material that has to be hauled off. You may also have to consider microbial testing. As an inspected facility, there may be some of this testing involved just to show that you're tracking your food safety and doing a good job of operating a clean plant. Then, of course, solid waste management. Everywhere you go, every business is going to have a dumpster out there in the parking lot that has to be taken care of one way or another. So all these monthly expenses get multiplied by 12, then added into the rest of our profit and loss statements later on. Tax information relates to property tax for the plant and an income tax rate, which the business may have to consider depending on the way it's structured. This line of operating credit relates to short-term borrowing. So just in the course of a year, if there's a time of year when things are a little slow and you have to borrow a little money and you pay it back later in the year when business picks back up, that's what this is intended to be. So it's short-term borrowing, an estimated amount, and an interest rate for that. Other information that gets entered on this sheet: selling price inflation rate. Over time, the value of what you do is probably going to go up, and you'll be adjusting your prices accordingly. But also your expenses are probably going to go up as well. So there's an expense inflation rate. Maintenance expense in this template is determined as a percent of the total cost of the plant and the equipment, as is insurance. The discount rate for net present value calculation, this will be used on the return on investment sheet to help take a look at the value of this investment as a business opportunity. Now, more information is to be provided on plant, property, and equipment. But before we go there, I want to show you all the information we entered about all the processing and revenue generating activities is calculated on the market projection sheet. So we do 10 years of calculations. And as revenue goes up, or as the price or the revenue per head of livestock increases because your price inflation goes up year to year, then you see changes in the revenue as well. And things like the deer and the retail sales, we built in a sales growth percentage, so even the total volume is going up. Now, back to the operating production assumptions. As I said, there's more information to be added in plant, property, and equipment. Here's where you'll enter everything about your building, every aspect of your building. And for our shell metal building, we even assume that there's a salvage value. After depreciation has been considered, when it's all said and done, this building 40 years from now is still going to be worth something. So that's the value we put in here. For equipment, for special purpose buildings like a storage shed, for company cars and delivery trucks, all of these, the depreciation is figured on different levels as opposed to the straight line depreciation used for the facilities. You can even enter in the cost of the land where you're going to build your plant and financing assumptions. So we have $558,000 total for the cost of building and equipping our basic plant in this example. Let's assume we're going to borrow 80% of the money for building this plant, or $447,000. I can put in information on the loan interest rate, the number of years I'm going to be paying this loan, and I even have a sheet in this workbook where it estimates the principal and interest payments for the debt financing. Then down below are all my depreciation calculations that will get used in my profit and loss statement. I'll also have expenses in personnel. Payroll information relates to all the cost of payroll taxes, workers' comp, fringe benefits that you may have in operating this business and hiring employees. We even allow for a wage inflation. If you're considering for all your other prices and all your other expenses to be adjusted over 10 years by an inflation rate, you can do the same thing for wage. You can enter in information on each position that you may have. The salary data that we're using here is just some of the national average salary data that we got from the Bureau of Labor Statistics. If you have more than one person for each position, you can increase the number of people you may need. The spreadsheet calculates the salaries, the benefits. You can even enter in overtime if you think there's a chance that most of your employees will work overtime during the course of the year, or if you want to put in a small percentage to include as a year-end bonus. You could treat it that way as well. All this information goes to the expense projection sheet. Now, the expense projection sheet takes everything we've entered so far in terms of cost and estimates for years 1 through 10 all the expenses of operating this business. Year 0 that you see here is a startup year. So instead of calling it startup, we just call it year 0. Year 0, you also have the possibility of some startup costs. There may be some supply issues that are related to getting the business up and off the ground. There may be permit issues, construction permits, operational permits, any type of local business permit that you're going to have to pay before you can build and operate your facility. That's what you would do in the startup year or year 0. But also you may have supplies and miscellaneous expenses in year 1. And these increase for years 2 through 10 by the expense inflation rate. And you'll notice as you go through the template, there are a lot of helpful little hints and comments that are provided with most of these input cells to kind of give you an idea of what information you need to provide in each one of these cells. Now, after we've entered in everything that we have for revenue generation, every expense that we have across a wide variety of expenses, we can skip to operation summary, which estimates before and after tax profits or losses for each of the 10 years, and including year 0, because we have some startup expenses possible in year 0. But it also estimates annual cash flow. So it takes the after-tax profits, adds back in depreciation, subtracts out the principal payment of the loan, and gives you a rough estimate of annual cash flow. All of this information, nothing gets entered on this particular sheet, but all of the information that is generated for profits and losses and cash flows is utilized on the return on investment sheet. The return on investment sheet is where we make use of that discount rate for net present value calculation that we entered back in operating production assumptions. We use that to estimate our net present value, so determine if this is a better investment than some other guaranteed investment that would have paid us a 10% return on our money over the 10 years where we're operating this business. And in this case, for our basic example, that net present value is a positive dollar number, which means the return is greater than 10%. And in fact, our internal rate of return is 27.5%. We also make estimates of return on assets, return on equity for each one of the years, but also an average over the 10-year period. And we even estimate payback period, in this case 6 years. What that means is it cost a total of $558,000 to build this facility. That was what we estimated in our base case example. Now, some of it was our money, some of it was money borrowed from the bank, but regardless, $558,000. From our net cash flows, what this tells us is it would take 6 years of our net cash flows to pay back that whole $558,000. So you have a number of ways that you can look at the value of this business in terms of its value as an investment. I hope that you enjoy using this spreadsheet. I hope it is beneficial for you. It doesn't replace a full-blown, let's call it full-blown feasibility study or business plan, but it's a good starting point that allows you to play what if. You can change information in one cell. Everything else in the template automatically adjusts. It allows you to see how sensitive your inputs are to changes in a value or changes in a volume. If you do have any questions or comments, about this template, please do not hesitate to contact me. My information is provided right here on the introduction sheet. Good luck.